The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers from Akers Financial Group. I'm a certified financial planner and practitioner from Akers Financial Group, also president and founder of Akers Financial Group, who is the actual, we take care of the show, Winning in Retirement radio podcast, and we welcome you to our show. Today is called Election Year Investing, and we wanted to do this topic, but we wanted to bring in one of our portfolio managers, Mark Diorio from Brookstone Capital Management. Akers Financial Group has been working with them for more than 10 years. They help us with third-party money management and portfolio design, a lot of things. And we want to welcome their Chief Investment Officer, Mark Diorio, to our radio show today. Good morning, Mark.
Good morning, Brian. Happy to be here. I'll try to provide enough information that we can invest on.
I'm sorry. The information officer is something I was talking earlier to someone about, and it got stuck in my head. Well, the investment officer, what kind of role does a chief investment officer at a portfolio management firm do? What do you do each day?
Sure. So I think of it in three categories, and that's really how I organize the investment opportunity set, which is one, we monitor the markets. So those are stocks, bonds, macro and microeconomics, earnings growth, where interest rates are headed, and so forth and so on. So that's the markets to really give us what type of investing backdrop do we have now, and where do we think it's going, both in a 3-month and a 12-month kind of time horizon. And then second, we build a number of investment portfolio models or strategies and make those investment elections and selections based on what the macro backdrop is. So we make those decisions, and that's kind of the daily management of the portfolios. And then third, we also monitor what we call managers, where we look for third-party money managers, or we look for, in this environment, we look for a lot of new innovation from exchange-traded funds or ETFs. And so we look at different investment vehicles, and that can be alternative investment vehicles. It can be traditional mutual funds. It can be just different strategies that have been coming on board. And so we have a structure in place and a committee in place to review those new investment vehicles to see if they'll play a role and kind of have a set research strategy around those new investment vehicles and how to implement them. So really those three categories, markets, models, and managers.
Yeah, that sounds like a little bit of a job. So you come in around 4:30 in the morning. You work 25 hours a day.
4:30 Eastern time.
Yeah, absolutely. So Mark Diorio is here for our show today. We're calling the show Election Year Investing, and we want to talk about the economics of 2024 and seriously talk about everything that's on people's minds. So this show is really a way to get information out to you about what you need to think about, what you should do with your own personal investments this year. Now, Mark, I'd like to start with what happened last year, 2023. Can you tell us the story of 2023 for us, Mark Diorio?
Definitely. So I think it was, just recalling back to the end of 2022, we had one of the worst markets where both stocks and bonds declined at a double-digit pace. So you had a bear market in stocks, and then you had actually a really big decline in the bond markets as well. And the reason bonds went down was because interest rates moved higher. And so the Federal Reserve was in an interest rate raising campaign to cool down inflation. And so we really ended 2022 on a sour note, and the expectations for 2023 through most economists were fairly negative. From an investment perspective, though, we see that and saw that at the time as the potential of an opportunity where markets could start some type of rebound. And that's because expectations, sometimes all you need is news not to be as bad as the expectations were, and a market can rally or kind of correct itself. And a lot of time, and last year, that's what happened. The news wasn't as bad. We did not enter a recession, and the recession kind of thesis kept getting pushed back. And so you had stocks climb this wall of worry essentially all year, a little bit of a sell-off in the third quarter, but then rallied to finish the year. In other words, so the markets were taken, or at least the commentators were taken by surprise, but the markets did what they usually do, which is kind of surprise most of the talking heads and surprise on the upside. And sure enough, we had kind of the losers or the leaders on the downside in 2022. Those are technology stocks and some of the big cap tech. Those turned around and led the market higher in 2023. So it was a nice rebound year for equities, definitely in 2023, which leads us into 2024 in a sense where we've gotten to a point where the Fed has raised rates 11 times. And and we think that they're about done with their rate raising campaign and may start to reduce rates when we look out into 2024. So I think, year to year, you always look back at what happened the prior year that sets you up a little bit for the following year. And this year we started, at the end of 2023, you really had a nice melt up in stocks where you kind of finished the year with a Santa Claus rally. And now we're a little bit overbought and maybe there's some sideways action just to digest those 2023 gains.
Yeah, I've been telling my clients, my little story is this, is that October of 21 was our last high on the Dow and the S&P, things like that. And then 22, we fell in a hole. And then in 23, we basically are coming up out of that hole. And in most cases, we haven't done the prairie dog thing where we popped our head above the 2021 rates. Indexes might have jumped a little bit in certain stocks, but generally, it's like you fell in the hole and all you did was recover up out of the hole. You didn't really make true money if you've been invested since 21. So this is sort of like you called it a Santa Claus rally and a bunch of other comments in there I thought were funny. But the idea of what you're saying is that the market had 11 rates going up, 11 interest rate hikes, and then there's a pause. That was one reason the market could go up. I think you would probably agree that inflation, basically inflation hasn't gone backwards or deflated at all. It's just the rise of inflation has slowed down some, which also is positive for the market.
Definitely. So one of the things that hurt 2022, or the main issue, was that inflation was just really sticky and continued to grind higher. So inflation is basically the general rise in prices from year to year. And so, as you're mentioning, when you have we hit a 9% inflation rate, that obviously was real sour for the markets and was really challenging for stocks and bonds as well. But since that time, we started to come down with that year-over-year rate of change, and now we're in the 3 to 4% range. I think headline close to 4%, and in the mid threes for the core. And the difference is the headline CPI includes all the goods and services that they measure, and then the core CPI strips away volatile food and energy prices. And so you'd say, well, the headline's really important for me as a consumer, but for economists, they really look at the core because energy markets go up and down. I think one of the surprises, though, would be that oil prices, despite really a continued elevated geopolitical risks out there, oil prices are in the mid $70 a barrel range. And we're thinking back 18 months or so ago when you had the Russian invasion, that oil could be at 120 or higher than that for an extended period of time. But that reduction in oil has really flowed through and into the rest of the inflation environment, which shows that the year-over-year has changed and has been reducing quite a bit, which did help and provide a tailwind to stocks in 2023.
Yeah, so you're saying the oil price does have a great effect on that inflation because oil is used in so many ways, and that's a great effect on just regular prices?
Correct. And so even though the economic intensity of oil has reduced over the last 40, 50 years, meaning that it's not as a big a percent as it was at one time, especially gasoline, for example, just because of improvements in efficiencies and so forth. It still is really a big barometer just for the reasons you said, Brian. So it is something we definitely monitor, and we look at the 6-month rate of change is a pretty good indication on the direction of where inflation goes. That correlation is pretty high, and it will be continued to be monitored in 2024. But it's also helped the consumer where you have those gasoline prices at least not rise and well off the highs that they were. So that's an interesting market still.
Yeah, so the reality is that prices haven't gone down. It's like when you go shopping, grocery shopping, car shopping, anything, it's really just the prices have stopped rising as fast as they were. So that's a good
Correct.
that's a good idea for people to feel like, hey, we can take a small breath with the dream that they would actually go back down. If prices went down, you'd call that deflation?
Correct. And so we somewhat battled that in 2008 environment. Deflation is where you have the general decline in the prices of goods and services. So that's not a great scenario. It doesn't happen all that often. In certain pockets, it can, but that's just not an economic scenario that works very well. And so the Fed is always concerned about making sure that you do have a little bit of inflation as well. And sometimes people forget about that you want a little bit of inflation in the economy.
Yeah, I guess I just like a return of some prices to drop back down again. That's more of a dream, I'm afraid. I wish that when we do the year in review, we could undo or fix some things. Let's say that happened, but let's erase that. Let's fix that. Now the idea is that 2024 is a big year. 24 is an election year for the United States, and that does play into the markets, and that's going to be the big topic as we run into our second quarter here. So what Mark's done here in the first quarter is established at Brookstone Capital Management. They manage $9 billion, and he's the Chief Investment Officer. I said it right this time, from Brookstone Capital Management. He's with us the whole hour, and we're going to talk about the economics behind an election year investing and what you should be doing. Now, Akers Financial Group, we work with Brookstone. We work and affiliate with Brookstone. We're not employees of Brookstone because we're local. We're independent. We don't report to any big company on Wall Street, Chicago, anywhere they might be. We have offices in Forest Hill and Lutherville, clients all around the region, all around the country, and a few even all around the world. It's so easy to begin winning in retirement and to begin working with us. All you got to do is call for a free consultation with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule a free in-person or Zoom meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. 2024 is an election year. How might that affect your investments? We'll explain when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome to Winning in Retirement. I'm Brian Akers, Certified Financial Planner Practitioner from Akers Financial Group. Here with me today is Mark Diorio, Chief Investment Officer from Brookstone Capital Management out of Chicago, Illinois. Good morning, Mark.
Good morning, Brian.
Great to have you here on our show. This year in the second quarter, we're getting ready to roll into the topic of election year investing. 2024 is an election year. I want to really have this topic be about what do you see, how that's going to affect their investments or affect their ability to invest. What's your thoughts on this election year on the investment side?
Well, I'll mention the ability to invest that now that you mentioned that, because I think this is an important point. We are going to face a lot of headlines, a lot of emotions during the year. And the media is going to play into that, try to generate more and more emotions. But I also think that it's important to have an investment plan so that you're not susceptible to necessarily changing it based on emotion. So you want to make sure you build a strategy that really contemplates what happens in any given year, including in election years, but in such a fashion that it's an appropriate investment portfolio that's really designed to get you to your long-term growth goals. Now, having said that, taking a step back, when we look at market history on election years in particular, when we went back to 1950, election years typically have some sideways action for the front part of the year, which differs a little bit from a normal year, which has generally a rising market up until maybe May, and then you have maybe a little bit more sideways action, and then a year-end rally in the fourth quarter. Here we have essentially the front part of the year really figuring out who the nominees are going to be, maybe a couple of headline-driven zigs and zags. Then a little bit of a rally mid-year as the markets identify who the candidates are, and then maybe another little bit of a zig and zag as kind of headlines start to ramp up in the third quarter. But then ultimately, after the election, the market is back on track and has a year-end rally. So overall, historically, they've had a positive return, just a little bit lower return than a normal market year. And the other part of that is it does show that you'll have a little bit more volatility in markets. And I think that's the day-to-day movements and kind of headline-driven markets. And I think it's important to remember that your long-term return is not necessarily going to be driven by the short-term headlines. Now, your short-term return from week to week or whatever the narrative happens to be that week maybe can be impacted, but your long-term return really isn't. And that's because markets overall are driven by the underlying fundamentals of the economy and earnings, essentially, of companies.
Yeah, so when you say all that, what I hear is I should be patient in an election year, but then my response is, I don't want to be. So what that means is that investors are like, well, where can I jump in, jump out? Can I play this game? Almost like a video game. Can I bet on red? Can I do something to make money? And then the reality of what I hear overriding in your conversation is that there are opportunities long term that are always great to be in diversified portfolios. An election year is not different than any other. But the amount of noise, the amount of information out there is going to make us emotion and might make us do the wrong thing by jumping in and out. Is that fair to say?
Definitely. Because when the market will start to move higher, it's not altogether clear that anything has been solved or that, you could still have negative news or emotional news, for example, that's suggesting just like we were speaking before that, at the end of 2022, a lot of the news was negative and nothing was necessarily solved, but the market just decided to rally saying, well, it's not as bad as expected. And so there's not a bell that goes off that makes the market turn around. Yeah. And you could look at even the market was declining for a few months into essentially the end of October last year. And then all of a sudden you flip the calendar to November 1st and the market essentially started a pretty aggressive rally that didn't really leave you time to say, well, we'll wait till it slows down. It just kept going into the end of the year. And so those things happen in the market far more frequently than is often considered, just how quickly the market can change on a dime and start moving. And then the narrative comes out as to why it's moving after the fact. And so I do think it'll be challenging as far as if you're trying to time it based on news headlines, because those headlines, as we all know, are flying around. I can't tell you what the headline was 3 weeks ago or 9 weeks ago or so forth. It changes, but I know where the market's moving and what history suggests. And also corporate earnings. And earnings come out every quarter. So they're not coming out every day, for example, that would drive the kind of the little gyrations in markets.
Right. The way I hear you saying that, I think we're really talking about when you invest your money, you really want to pace yourself. You want to invest for the long run and not try to guess. Now, I've always said that when it comes to stock investments, the key thing is being in the market so that your overall allocation, you allocate a portion to stocks and you're in the market so that when things change quickly, you're in the market. You don't have to make another decision of, it's time to buy, or is it not time to buy? Or if you jump in emotionally, you end up buying and selling at the wrong times where people lose even more money because of adding emotions and to their purchasing.
Correct. I think you have it spot on, Brian. It's time in the market, not market timing. And really, and I know you go through this with clients, Brian, as well. You go through a risk assessment or financial fingerprint, where you basically are trying to allocate those portfolios consistent with the risk profile of the client. You didn't decide that, your risk profile's changed because it's 2024 and there's an election year. No, this is going back through looking at all of market history, contemplating all those different elections, all the different geopolitical events, all the different headlines, and really using a fundamental approach to dial in on what's the appropriate mix of stocks, bonds, what income generating from the portfolio, what's the level of market risk that you have. And if it's an appropriate portfolio, it's really saying that it's going to get you to your goal, taking the least amount of risk possible, consistent with your risk profile.
Right, absolutely. So election year investing. So elections, we're going to have a different style election this year. There's people running for president. There's a lot of, I guess you were saying that there's going to be a lot of volatility and noise. How does just really not sure what's going to happen on the government really affect our decisions on investing?
Well, definitely. I think that's the big risk where you all of a sudden, you've put together a good plan, and then because of some uncertain headline, you decide to change the plan. Well, the plan didn't think you were going to change it midstream. And the problem with that is the market can move higher based on, I can tell you one thing that the market is thinking about now that might catch it by surprise to move it higher is that we may have a surprise in productivity gains that we haven't really seen in a number of years. Part of that could be due to artificial intelligence improving productivity, and it could be a pretty good move. That's just something that we're watching to say, you know what, this could be a real surprise to the markets that productivity improvements, and we already see it now, are going to maintain, if not expand, margins for certain companies, profit margins for companies, and that could be a boost to stocks, for example. And the stock market might say doesn't matter what's happening with politics. But I would say when we go back, one of the most politically unstable election years with kind of social unrest and so forth would be 1968. There you have kind of the Vietnam War gets accelerated with the Tet Offensive in Vietnam. Then you have a couple of assassinations, MLK, RFK, and the market basically had a little bit of choppiness for sure, had kind of those two little sell-offs that I mentioned, kind of consistent with history, but ultimately had a positive year. So it just tells you that sometimes that all that is going on, that the market is different than any narrative or single headline.
Yeah, I guess this last quick question I have is a recession or not a recession coming in 2024?
So that's probably the bigger issue than the election in a sense for the markets. If you have a recession, you would have a rally in bond prices, interest rates would decrease. Right now, it doesn't look like a recession. In other words, 18 months ago, you had a lot of thoughts that we were going to enter a recession, but it just keeps getting pushed off and pushed off. And I would tell you that with unemployment below 5%, it's going to be pretty hard to get a recession. So unemployment would be the number that we're looking at. If you had a lot of unemployment, in other words, companies really raising that unemployment number, laying off workers, that would be a risk. At the moment, that's not the case. You hear about it from a few big companies here and there, but so far unemployment is below 4%, let alone the 5%, which is kind of considered full employment level.
Right. Yeah, so this whole thing ties into the unemployment number you're mentioning. Unemployment, when it's really low, the number, that means that there's going to be a lot of people that are not looking for jobs, but a lot of employers looking for people. And so the thing that we're going to look for this year is looking for the opportunity that people are going to be looking for jobs, and then take more time to find a job because it's going to be harder to find. But that's good for employers so they can actually find the people they need, especially in the areas that are growing. So this economy we're in is going to be driven by the workers, the ability of workers to actually come to work for you versus the ability of not being able to find people, which can be a very hard thing for employers. So all this information leads to election year investing and election year emotions of should you invest or not. Now, the idea of all this is the show's called Winning in Retirement because we want you to win throughout your retirement years. Because we all know the best part of retirement is when you get your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com. Or you can go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule your free in-person or Zoom meeting after you've contacted us. So go to our website, akersfinancialgroup.com, or call us at 833-946-7384 to start planning for your retirement now. What direction are interest rates going? We'll talk about that in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group. I'm a certified financial planner practitioner. I'm also founder and president of Akers Financial Group. And we welcome you to our Winning in Retirement radio podcast. This is our second half of the show. On this show, we have Mark Diorio, Chief Investment Officer from Brookstone Capital Management. He's been in the industry more than 20 years, and he's been working along our side and helping our clients by managing portfolios and helping us with third-party managers as we try to work through the proper ways to build allocation and invest money for our clients for the years getting ready to retire and throughout all those retirement years. So, Mark Diorio, welcome to the second half of the show. You ready to go again?
Well, we got to do the second half, Brian.
And the second half leads to the fourth quarter when it's winning time, and that's the key here. Winning in retirement is winning time. But one of the things we're doing this today is election year investing, and I got to bring up the hardest subject, and that is this. What direction are interest rates going? And I need exact numbers, Mark. I need to know what day. Actually.
All right, let's get into some detail.
All right.
So short-term interest rates are driven by the Federal Reserve, and they raise or lower interest rates based on what they're trying to promote in the economy. So their two main objectives is to basically maintain stable prices. Think of that meaning inflation in the 2% range. And then the other part of their dual mandate is to implement policies that would promote full employment. So right now we have essentially full employment, that's unemployment below 5%, but we still have inflation a little bit elevated, even though it has come down, but it's well above that 2% range. It's in the headline is around 4%. So I think the primary goal or objective right now, as it has been over the last 18 months or so, is to keep those rates a little bit elevated, higher. So the short-term rates are about between 5.25% and 5.5%. So that's the Fed funds rate. That's the rate that they set, which is essentially the overnight rate that banks lend to each other in the overnight market. So that's a little wonky number, but it gets pushed through into different, your savings accounts, your treasury bonds, different bond investments. Then you have the 10-year treasury. That's the bond that the government issues to essentially fund the government. So they issue a 10-year treasury. The rate is currently around 4%. So the government can actually borrow for 10 years at a rate below the rate of short-term rates. So this is called an inverted yield curve or interest rate situation where longer-term rates are actually below shorter-term rates.
Yeah,
so I think the Fed is...
Yeah, Mark,
go ahead, Brian.
An inverted yield curve, you're saying that interest rates shorter term are higher than longer term. So why would anybody buy a long-term bond then?
The reason that someone would buy a long-term bond are really twofold. One, they basically are a pension fund and they have long-term liabilities out 10 years, 20 years. And so they have to buy those longer-term bonds. The other reason is for portfolio managers might think that, oh, well, if rates are going, if the economy is weakening, I think long-term rates should be at 3%. And so the bond prices are going to rally 20% from this level, so I'll get a really good return. And so if rates are going down, you want to have longer-term bonds if those long-term rates are going down, because you'll get a higher return. And that may surprise some people that you can get a big return in a short amount of time if rates move like that. And so that's why they would. And then those are shorter-term investors that are moving in and out, but they can make that play. So it is interesting. It was a situation for a while, of course, that why would you buy a 10-year Treasury when it was yielding 2% or lower? Now at 4%, you get more normalized type numbers. That's still below most of the modern history over the 50 years, which is about a 6.5% average, or 5.5% to 6% average type of return on the 10-year. I don't know if we're going back to that level. But if growth starts to speed up, you'd have those longer-term rates rise a little bit. If growth starts to slow and there's the fear of the recession, you'd see those longer-term rates decline. The expectation in the market is that the Federal Reserve will reduce rates. The expectation actually coming in the year was they'll reduce rates by 1.5%. I think that might be a little bit aggressive. I could see them reducing rates if inflation continues to come down a little bit, reducing rates maybe 0.5 to 0.75% this year. At least that's what they put in their plan. Unless inflation continues to be sticky, then they'll have to keep rates higher than they have been for some time.
So if rates go down, will mortgage rates actually go down on that, or will it affect housing? What's going to go on there?
So housing is a pretty interesting situation where you'd say, geez, house prices have actually continued to rise. And that's because housing costs really had an increase in 2020, back half of 2020 into 2021, 2022. They have not really declined. So housing costs have been elevated, to build a new home, but then also house prices have risen and really haven't come down either. And so you'd think that, well, you have higher interest rates and it's going to bring down the prices of houses. I think you have a supply issue here where there just is not nearly as many houses out on the market. And that's because those that bought their house or refinanced their house and at that 3%, 3.5% type mortgage range aren't really keen on making those moves or refinancing at a higher rate. So I think that's an interesting situation. But I think that's actually part and parcel of what we're going to see for some time, meaning that the supply is just structurally less than the demand for some time. And unless building costs start to drop where it would be beneficial to improve that supply. But you have kind of millennials at their peak family formation years, so that'll keep pressure on, I think, in the demand for houses strong, where the supply, if you're locked in at that 3.5% range, it makes it a lot more costly to move and then acquire a new mortgage at essentially double that rate and that price.
Yeah, so the supply and demand, I know there's a demand there, and then the supply are sort of people just waiting. It's like they can't, it's like I'm not sure if the word is they roll into your next house or upgrade to your next house. You just are just gun shy, because if you don't get rid of that 2.5%, 3% mortgage rate to jump into another house that's more expensive, and all of a sudden your mortgage just jumps way up. It's hard. Unless you have to. And some people have to right now in this market, and that's that's driving it. Mm-hmm. So the election year and interest rates, what's your opinion of how the election year and interest rates play together?
So I think it's really more of a function of where inflation goes. But I would say, in other words, if inflation stays high, they're going to keep, interest rates are going to have to move a little bit higher. If inflation starts to really decrease, or accelerate on the downside, you would see interest rates going lower. I would say historically, from a Federal Reserve policy perspective, they've typically not done too much during an election year. They kind of want to do what they're doing with monetary policy kind of the year before. And that certainly seems the case where the Fed really started in 2022, or back half of 2022, and then into 2023. but since July has not made another move. And so I think they want to try to be in the background and not really have to exert their influence on markets overall, because that can impact the election for sure. Whether you have a recession or not a recession can definitely impact voting. And so I think they want to step back and let that process play out.
Can I ask, I know this is a near impossible question, but the amount of national debt and the bonds that they have to issue, do we really control our interest rates anymore, or is it more market driven? Is it sort of what kind of game is it?
So the very short-term rates that the Fed controls are those overnight rates. And then when the government issues those treasuries, they issue them for different time periods or maturities. So they could issue 2 years, 5 year, 10 year. And it really depends what they're trying to do. Treasury's trying to do is identify where that demand is at and supply, and for the supply that they have to issue. In other words, if they see a lot of demand for 3-month paper, they might just keep issuing 3-month paper. If they see demand out there in the 10-year space, they'll try to issue it at the 10-year space. Now, it is true that we've seen really a change in the structure of the Treasury market, in the sense that we've seen a little bit less foreign ownership of treasuries. Japan's our largest, followed by China. But as a percent, that has declined in our ownership. And so it has been largely public pension funds, banks, and so forth that own the Treasury market. But those are, as you mentioned, those are market-driven rates. And so the more that they issue, well, the market has to absorb that. So if they issue too much, maybe the market says, well, we need a higher interest rate to attract enough capital. But they have been pretty steady and consistent. And as I mentioned, they are below short-term rates. So the marketplace does have enough liquidity to absorb that. But that is something that we are watching, which is an outside risk to us. But it is one that's on our radar, which is, well, maybe they're issuing so much that rates do start to go higher than the market expects. And so that's definitely on our radar.
Yeah, well, this interest rate topic is a big one, especially during the election year, and really when we're making our long-term financial decisions. Now, at Akers Financial Group, everything is about you. It's about you, the client. And what we want to do is be your advisor. At Akers Financial Group, we want to work through your expectations of risk and goals of what you want to accomplish with your investments over time. We want to deliver a portfolio that takes below market risk and still gives you great returns over time. The idea of investing your money has to be incorporated into a financial plan. At Akers Financial Group, we call that the fingerprint. We really want each and every person to sit down with one of our team of advisors and go through your unique financial fingerprint to design exactly the portfolios that you need when it comes to your investments to deliver on your family's goals. So if you'd like to sit down and hear what we got to say and understand how we can try to help you, we have a free consultation. You just give us a call at 833-WIN-RETIRE. You schedule an in-person or Zoom meeting with one of our team of advisors. That's 833-WIN-RETIRE of 833-946-7384. Or you visit our website, akersfinancialgroup.com. Scroll down to the bottom of the page and schedule a meeting right there. So call us at 833-WIN-RETIRE or go to our website, akersfinancialgroup.com. Where should you be invested right now? We will explain when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement, our radio podcast put on for you by Akers Financial Group. I am Brian Akers, president of Akers Financial Group. Here with me today is Mark Diorio from Brookstone Capital Management. Brookstone Capital Management is a firm where we use them for third-party money management. They design portfolios, trade, and invest that money that usually is actively traded, money that's at risk is what we try to call it, is portfolios designed to help our clients beat inflation after tax over time. And so Mark Diorio is here today talking about election year investing. Here in the fourth quarter, we've got the hardest hardest topic for you, Mark, so I hope you're ready. Are you there, Mark? You ready?
I am. Thank you for saving it for the fourth quarter.
I haven't knocked you out with the tough questions yet. So what's cool is this. Now, the reason I asked if are you there, because it's a hard one. It's this. Where should you be invested right now? I mean, right now. Where should we put our money? Come on, Mark. I need some information, man.
Well, I know we've talked a little bit about the election year and kind of building your portfolio, but we do have some specific strategies that we think are definitely consistently deliver value to clients with specific objectives in mind. One of those would be a dividend strategy. And a dividend strategy using dividend-paying stocks are typically blue-chip stocks that pay a portion of their profits out to shareholders as a dividend. Now, these often get lost because they don't get talked about as much on the financial media. They're never going to be the hot stock or the have the hot new technology. What they are sound companies that have made it through, in often cases, decades of different business environments, have really developed a moat around their business, meaning it's hard to compete with them, whether it's their technology, their efficiency, whatever it happens to be. They've really carved out a spot in the economic landscape that they can consistently apply. And then the benefit as a shareholder is you get the dividend or income coming in. You don't have to sell a share of the stock. You get the dividend coming in, and the dividend is not determined by the market. It's determined by how the company is doing, and the board of directors of the company set the dividend. So certain companies, and we think this is a unique group because it's not easy to run a business for decades and have consistent profits and so forth that they can share with investors. And so that value proposition is actually more unique than I think investors appreciate. But in particular, if you're nearing or at retirement, it says, well, okay, I can get income being generated off my stock portfolio, and then over a long period of time, we expect the stock to appreciate in value. So you get both the income component and the stock component. And one specific thing about dividend stocks is the dividends can grow, and many great dividend-paying companies actually increase their dividend, the dollar payment to investors year in, year out. And usually they grow faster than the rate of inflation. And so your income is actually growing without you actually doing anything or necessarily buying more shares. So you can either take that dividend and buy more shares, reinvest that dividend, or receive that as income if you wanted to spend some of those dollars.
Yeah, so that's a dividend. Dividends pay money as you hold it, right?
Correct. So as you're going on, most companies pay a quarterly dividend. And so what we do from a strategy perspective is we try to review all the dividend-paying stocks and the criteria is they have to be high-quality companies paying an above-average dividend. So you can think of that in the 4% range, right. Some higher and so forth. But then also selecting stock baskets that are trading below their estimated fair value. And it's a fundamental fair value rating that we use. A third-party analysis firm called Morningstar to help us identify those companies that have those characteristics and are trading below their fair value. So you're getting a reasonable price when you're allocating.
And then the other basket at Brookstone, you have a dividend value stock basket. I'm sorry, a value stock basket, a dividend stock basket, a growth stock basket. There's all kinds of different portfolio designs and choices based on the outcomes we're trying to achieve. I know there's investments that are designed called a buffer. Do you mind mentioning a few of these topics and tell us a little bit about each one?
Sure. So the dividend stock basket would be a collection of 20 to 30 dividend-paying stocks. I was just mentioning how the dividends and the value of those. The growth stock basket is the same type of idea, identifying high-quality growth companies, though. So different. It's not a dividend focus. This is growth stocks. So a lot of the technology stocks would be in this one. And we look for those that are trading below their fair value. And what's important about that is, growth stocks are more volatile, so they can run up quite a bit. And sometimes you're not sure if they're reasonable value or now are they overvalued now or so forth. So those we monitor quite a bit. And then you can always find or look for those growth stocks if you like to be a growth investor that are trading below their fair value. And then we move those around as they rally, for example, and so forth. But the other interesting one that you mentioned is something called buffers or buffer ETFs, exchange traded funds. So a lot of investors like to participate in the equity market, but they maybe not like the drawdown or the decline when it goes down. And so what buffer ETFs do is they're really an innovative investment vehicle where they allow you to participate in the upside of the market up to a cap level. So you know ahead of time over a 1 year period how much of the upside of the S&P 500, for example, would I participate in if the market rallies. And then on the downside, it can buffer or absorb the first 9% of the downside, the first 15, or there's one of the strategies buffers between a -5 and a -35% of the downside, meaning, well, you get the first 5% of the downside, but then for the next 30 after that, you basically be buffered against any losses. So these are really interesting vehicles that, as I mentioned, they've been around for about 5 years, I want to say now. We spent a lot of time researching these, and we found them to deliver on that value proposition consistently. So that's been a growing area for us. And part of that was in reviewing different managers or some of these third-party strategies that we look at, and then deciding how do we build a strategy around that, and then implement it in an appropriate fashion for clients.
Yeah, that's excellent. So the idea here is when it comes to portfolio design, at Akers Financial Group, we sit down, talk to the client, we really work with them on what they want to achieve, and then we go out there and seek everything we can when it comes to designing a portfolio to let them work together. And so we're able to achieve different sleeves of investments and different managers all in one account. Has that been a good way of investing money, Mark?
Definitely. So our overall investment philosophy, you can think of it as a core plus satellite allocation design, which means, well, we design a core portfolio. What's the mix of kind of traditional stocks and bonds that's consistent with your risk profile, but then include what we call satellite components to that, or sleeves, as you mentioned, where you could have different strategies that complement the core portfolio. Maybe you want a little bit more growth out of that core basket, so you can add some growth stocks to that, or maybe you want more income out of that core portfolio. So it gives you a lot of flexibility in how you really hone in and customize that portfolio for the individual client. And one area, I mentioned dividends as an area of both income and then ultimately growth with stock price appreciation. But one of the interesting income areas that we spent a lot of time on here and have used for several years now is something that most investors don't come across, which is something called structured notes. Structured notes are a financial instrument that are issued by the major banks, not through their bank channel. It's actually devised by the Capital Markets Group, or their desk in New York, and go out to financial professionals. And what we've really done is customize a note for Brookstone clients, which has pretty interesting terms. It's a 1-year note backed by that banking group. So any of the majors, if you go to Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, we look at all those different players to issue this note, a 1-year note. And from there, you look at different payoff terms, and it comes with a coupon or interest payments that are paid on a monthly basis, quoted in annual terms. So let's say the interest payment is anywhere between 8 to 12%. It varies month to month, but you know ahead of time what that is. And then the other unique factor is this is not a bond where it's impacted by interest rates. If interest rates rise, the price of the bond goes down, and vice versa. The principal is repaid at par or dollar for dollar at maturity, but it's linked to, but the risk is it's linked to 3 equity or stock market indexes. So your principal is protected up to a 30% decline in any one of those 3 indexes. So as long as that doesn't happen during the 1-year time period, you get your principal back plus all that interest that's accrued. Now, when we look at that, 30% was a key number because it doesn't happen that often. It can occasionally happen. But we also devised in that sleeve or that strategy component, we suggest laddering these notes. So you wouldn't just own one note for one 12-month period. What you'd say is, okay, I'm going to spread out. I have 10% of the portfolio I'm going to put in these notes because I want above average income. Then I will buy several notes to spread out that investment. Just a simple ladder in the sense that, we'll put a piece in January, February, March, April, May. So then you have its own unique 12-month time period, and they each have those interest components, and you'd have usually multiple different issuers as well. So you also diversify by issuer.
Yeah, and that's why we hire portfolio managers, that description you just gave right there. And Mark Diorio, the show's flown by today. We do thank you very much for checking in with us here at the beginning of 2024 about election year investing. We thank you for this and your job that you're doing for our clients at Brookstone Capital Management. If anybody wants more information about this, you just call us at Akers Financial Group. What we want to do is this. We want to sit down and talk to you about your financial fingerprint. That's where you are now, and try to build these strategies into what is right for you to the future. Now, Akers Financial Group and Winning in Retirement, we thank you for listening to our show today. We want you to win in your retirement. So take advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can just call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and/or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.